So today we are discussing about equity investment. We will be discussing uh, capital assets pricing model and modern portfolio theory and yield curves. Right? So when we talk about investments, we will have single stocks or multiple stocks. So this particular model, capital asset pricing model, helps the investors to calculate investment risk. So it will allow us to decide what kind of risk we are taking and what is the return we should be expecting from this investment. This is a model developed by financial economist William Sharpe in his book Portfolio Theory and Capital Markets 1970. This is the most widely spread basic theory we use in modeling the risk and the return of an investment. When we talk about investment, it is share capital market and risk-free investment as well. That's a latter part risk-free, but mainly the capital market investments. In an investment, we have two risks rather, systematic risk and unsystematic risk. Systematic risk is the risk associated with the the market. It can be interest rates, it can be forex, it can be recession, which is beyond the control of the specific companies, right? The market risk we have, which is beyond the control of any industry. Then we have unsystematic or specific risk. That is the risk associated with specific stock. Like if we think about banking stocks, then risk associated with banking sector, risk associated with this specific company, right? So it is a specific thing. By increasing the number of different stocks in my portfolio, we should be able to diversify or reduce the risk associated from individual companies, right? So it says it is better to hold many stocks than just holding one stock, right? CAPM formula, the relationship between expected return and beta can be represented through the following equation. This is the equation we use. Beta is a factor derived by analyzing the specific company's return and the market return on a time scale, right? It is the relationship between specific company's return and market return, right? That represents the systematic risk in the industry. So this is the formula we use to get the expected return and the relationship with beta. RA is the expected return, RF is the risk-free rate return, then beta is the securities value, then Rn minus Rf is the equity market premium. That is the premium any investor will demand to invest in equity market, because equity market is risky. So whoever goes and invest in equity market needs a return over and above the risk-free rate, which is the treasury bill rate or treasury bond rate. Rm minus Rf is Rm is expected market return and Rf is risk-free rate. this RM minus RF is called equity market premium. This is what capital implies that the expected return on a security is linearly related to its beta. See, there is no power here. It is only a singular straight line equation. That's how this implies expected return is linearly related to beta. If you are familiar with the stock market, this is a very common calculation we do, and based on this beta, only we decide whether the stocks is riskier or less riskier, right? Beta measures the systematic risk, which I told you earlier. This is also I told. Beta is found by statistical analysis of individual detailed share price returns on comparison to market daily returns, right? So we can calculate beta or we can calculate expected return. Normally, this expected return should be more than the cost of capital of a company. Right? The stock of as example, we have a stock of a company A has a beta of 1.5 times, and the risk-free rate is assumed to be 3%, and equity market premium is 8%. Therefore, expected return for company A, you need to work out. You have the formula. Please work out this RA. Right? Once you finish, let me see. I know the equation is there and the answer also there, but I prefer you working out in the class. Right? Please work out, and once you finish, let me know. I'll watch in the text box. Ranga, thank you. Let everyone finish. You are correct. It is 15%. You have risk-free rate of 3%. Beta is 1.5. Then market premium is 8%. So it comes to 1.15% expected return. Work on this one. Suppose the stock of a company B has a beta of 1.3. The average beta on new project assumed to be equal to B's existing beta. That means the beta we have to consider at 1.53. Risk-free rate is 5. Expected market return is 13.4. What is the appropriate discounting rate? Right? So work on this formula and see what is the rate, market rate return. These are the figures. Madhurangi, it has to be a percentage. What about others? Right, let's go to the presentation again. Everyone please finish it. So this is the calculation again. Risk-free rate beta into market return minus risk-free rate, right? 15%. Then what is the use of this beta? If you are an investor, how do you use this beta factor? So in a growing market or increasing market, you should try to go beyond the increase on the overall market. Whenever you are investing with a beta factor which is more than 1, that means if market increase by 1 times, this particular stock's return will increase more than that. We say 1.5. So that means if market growth is 10%, this particular company's return would be 15%. Right? On a growing market or improving market, you should always invest in a stock where beta is higher than 1. When the market is declining, if you have a stock which has a beta which is more than 1, that means this stock's return will deteriorate faster than the market. Therefore, in a decreasing or deteriorating market, you should hold always companies where beta is less than 1. So, when the market drops by 10%, company will drop lesser than 10%. That is how we practically use beta in deciding the investment. Right? Then we will go to modern portfolio theory. Is the other part of the investment where we talk about diversification. MPT says that it is not enough to look at expected return and risk and return of one particular stock. By investing in more than one stock, investor can reap the benefit of diversification. As example, if someone has invested purely on hotel stocks, right? Now, hotel stocks are coming down, has come down rather. So, he or she will be facing the specific risk. If we can diversify, I will go and invest in financial sector. I will go and invest in freight forwarding. I will go and invest in export sector. Like that, if I can diversify my portfolio, whenever one stock is not giving enough return, I will get return from the other stock. So I can by diversification, I can get rid of the specific risk or unsystematic risk. This was developed by Harry Merkowitz through the article which was written in 1952 Journal of Finance. Right? This is how it happens. You have your systematic risk, which is the market risk. You can't do anything with it. Right? This is a plot against the risk of portfolio and number of stocks in the portfolio. Right? So you have the market specific risk which you can't diversify. This is your unspecific risk or unsystematic risk. Right? This is your total risk. So when your portfolio increases, number of stocks in the portfolio increases, your unsystematic or specific risk comes down. So you can continue to reduce your risk. Different authors talk differently. Some says even you invest 100 different stocks, you can't diversify everything. But some authors say when you invest more than 20 stocks, you reap the benefit of the diversification. Right? Then we have something called efficient frontier. Right? For every level of return, there is one portfolio that offers lowest possible risk. And for every level of risk, there is a portfolio that offers highest return. So always what we want, highest return and lowest risk. But based on the portfolio, we have a risk level. Right? If we get an idea from this graph, Coca-Cola is a consumable and a low risk, low return portfolio. Google is a high return, high risk portfolio. If you entirely invest in Google, you will have higher return and high risk. This is, if we plot the risk and the return, you will get this line. So best is to invest on this line, portfolio mix, which represent on this line, right? So you take a portfolio position, something like this. Then you have one part Coca-Cola and one part Google. So you will manage your risk. So the combination can be plotted on a graph and the result line is the efficient frontier. The maximum level of risk that investor will take on determines the position of the portfolio on the line. Before going to the other one, I have given you two handouts, Word document, PDF document. It gives you a detailed analysis on these two models, capital asset model, systematic risk, modern portfolio theory. This will cover later. So it can remove those. This is the formula. When we talk about risk-free rate, it is 10-year government bond yield normally in US, but in Sri Lanka we don't have that. So we take the government bonds. Beta is only relevant risk measure of stocks risk. This is what I spoke to you about. Right. According to CAPM, beta is the only relevant measure of the stocks risk. It measures the stock's relative volatility, that is, shows how much price of a particular stock jump up and down compared with the stock market as a whole jumps up and down. It is how it moves with the stock market. If stock market moves up by 1%, if it is 1.5, it will move up by 1.5. This 10 and 50%, which is 15. This is what capital means for you on this cover. Then we have modern portfolio theory. Again, we talk about diversification. Right? Then the diversification. You have our specific risk, not specific, systematic risk, which is the market risk, and we have our specific risk total. When you increase the number of shares in your portfolio, this will come down. Then the efficient frontier. So when sometimes we will have to invest in two different risks in order to reduce our overall risk. So one, like as an example, we have a hotel sector investment which gives you returns during seasons. So you should invest in another stock which will give off-season returns. So similarly, you have to balance your risk taking. Then only you can reduce your entire portfolio's risk. However, the problem here in modern portfolio theory is it assumes that each individual investments operate independent of the market and by its alone. However, when the market collapse or increase, all the stocks go as a herd towards the same. Right? If it is increasing, all stocks will increase. Returns will increase. When it is reducing, almost every stock will reduce. Right? So that is a drawback of this bond. Then again they say, when you are investing, if you borrow and invest on risk-free instruments, that is treasury bills and bonds, then always you can increase your return while you invest your own money for the equity market. If you borrow and invest in your risk-free market, you can have a return more than the efficient frontier. That is another part of the theory. So these two are the things I told you. William J. Burnett says even 100 will not diversify, where Edwin J. says 20 stock you will diversify your risk. Right? Those are the two that we go to. Yield curves. Right? Today is a short lecture. We will be finishing all things today. Maybe by even before 3 we will finish. Yield curves. Yield curve represents the relationship between interest and maturities. Right? So here again we say it is the term structure of interest. We will graph the yield and the maturity. Right? This slope of the yield curve, which I am going to show you shortly, slope of the yield curve represents the economic growth, whether we are going for recession or are we going for growth or improvement. We have three types. Firstly, we have normal or positive yield curve. Normally, when we plot a yield curve, we use treasury bills and long-term treasury bonds rates. Right? So you have the maturity here, yield here. On a normal or positive yield curve, it starts from a low and increase. Longer the tenor, higher the interest premium. What does that mean? That means business people or businesses expect growth in the future. Right? So people does not want to invest for long term. They want short term investments because they are expecting a growth always. Right? But if you want long term, you have to give a premium. That's why this has a higher yield, and here short term you have a lower thing. Right? Look at today. Today we expect short term returns. We expect short term rates to increase now. So everyone is trying to invest short term, not long term. So if you want long term funds, you have to pay higher to get a long term fund. So it shows this one. This is how the yield curve looks when economy is growing and investments are confident. In growing economy, investors demand additional premium for long-term maturity bonds. I don't know whether it is a good example which I gave, but it is how normal economies operate, right? Whenever we expect a future growth, people does not want to invest long term because they expect interest rates to go up. Therefore, they try to invest in short term. If you want funds for long term, you will have to give a premium to attract long term funding, right? But here in our country, it is a speculation. Everyone is waiting for the rates to go up despite any confidence on the growth, right? That's why currently everyone is putting money for short term, not because that we look at a growth and waiting for growth on the rates, right? So normal positive yield curve is this. Normally positive yield curve indicate a growth in the economy. Then we go to flat yield curve. A flat yield curve indicates that the investors are not being compensated for additional risk of long-term maturity. That means there is a, yes. Someone wants to speak to me? Right? Flat yield curve means we don't expect any growth or anything. It's a slow economy. So whether it is short term or long term, there is no much difference. Therefore, there is no premium paid for the maturity. So it is a slow growth or a steady economy, which is not growing or declining. Then we have inverted or negative yield curves, where we expect the rate, the economy to decline. Therefore, everyone wants to invest in long term. Therefore, if you want short term, you have to give a premium rate for short term, whereas long term, you have high demand, so you don't need a premium there. Right? Whenever recession or decline in the economy sees, this kind of a yield curve will occur. Right? So they say this is a very good indicator. All the previous recessions we faced, 1 year prior to the recession, we saw a yield curve, negative yield curve on the interest rates. Right? Always this will show you a positive or negative almost a year prior to it happens. Right? And again, the slope of this yield curve indicates how sharp the drop would be. How sharp the drop would be. So these are yield curves. It is a plot with a graph between the yield and the maturity, but it has to be same quality. So we use treasury bills and treasury bonds to decide the rates. So what the takeaway from this is, whenever economy is expected to grow, you will have a positive yield curve or normal yield curve. Whenever recession is nearby, it will have a negative where everyone wants to block their money for long term, whereas expecting short term rates to come down. Then if you want funds for short term, you have to give a premium. This is that. Right. That's all from me, from my all the lecture series. So during the like 2.5 days, what we did, actually this is a 3 days session. When we teach you on online, it goes very fast, right? So we discussed the credit policy, the important factors contributing to credit policy, and areas which needs to be covered under credit policy, the importance of credit policy we discussed. Then on our second lecture, we discuss about the credit administration function part. Then today we discuss capital asset pricing model, then modern portfolio theory, and the yield curves, right? So this covers the 3 lectures. So if you have any questions, I can answer you now. Any 3, all 3 classes are fine. You can ask me any questions if you want anything. You will get, I think, 2 questions from me. Normally, questions will come in smaller parts. Each question will have 4 or 5 sub-questions. So you can score based on the sub-parts. And again, I will be asking questions from the handout. So please go through handouts properly, and we will try to narrate it to real life cases.
Hello, sir. There's a question regarding this CAPM formula. In the first example, why can't the answer be 10.5%?
10.5. Let's see. Where are we? This one, right? So what is the
yes, sir.
We have a risk-free rate of 3, right?
Right.
Then beta is 1.5, right? Then market premium, risk premium. What is market risk premium? Market risk premium is market return minus risk-free rate.
Risk-free rate.
Right? So it is not market return. It is market premium, equity premium, this one. What you have done is this. You reduce 8 minus 3, you took that, right? 8 minus 3 into 1.5 plus 3. Then, then it comes to 10 point something.
Yes. That's how I did.
What I gave here, 8 is the market premium, not market return. Okay.
Yeah, got the point.
Right.
Thank you.
Okay.
Thank you, sir.
Anyone else? Right. If no questions, we'll stop here. And thank you very much. And when you go through the handouts, if you have any questions, give me a call. That's fine with me. Or drop me a text, I will call you. Okay. So all the best for your exams and learn subject matter. Thank you, Dev.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you.
Thank
Thank you,
you,
sir.
sir.
Thank you, sir.